Hi traders, you are welcome back to the Forex Geek channel, and in this particular video I am going to be showing you what mitigation blocks are. Okay, this is just going to be a breakdown of mitigation blocks in trading. Okay, we'll cover what mitigation blocks are, why they matter, and how you can use them to improve your trading decisions. All right, so what exactly are mitigation blocks? Now, a mitigation block is a zone where institutions have left behind unfilled orders, okay, after making a large move. So once price pushes strongly in one direction, it often comes back to retest that zone to mitigate or fill those leftover orders before continuing in the original direction. All right, so this process is what we call mitigation. Okay, why is this important? Now, it's important because it explains one of the most important questions that traders ask, which is, why does price always come back to certain areas before moving again? Institutions need liquidity to fill their orders. And when they leave behind these blocks, the market naturally returns to them to balance out unfilled positions. So if you can identify these zones, you can anticipate where price is most likely to retrace. Now let us talk about how to identify high probability mitigation blocks. Okay, these usually form after impulsive moves. When price suddenly breaks structure with momentum, right? Like what we can see happen around here. When price breaks structure with momentum, okay? You have to look closely at the candles that caused these moves. Let's go to a lower time frame for this, all right? Okay, so the last top candle before a strong down move, or the last down candle before a strong up move, often marks the area of a mitigation block. Okay, so in this case we have this. Okay, if you're going to narrow it down to 30 minutes time frame, you're going to be having this. If you're going to narrow it down to the 15-minute time frame, okay, we're going to be having it above here. Right, so you have to combine this with imbalances or fair value gaps. Combine this with imbalances or fair value gaps, and you will have strong evidence of where price is likely to return. So once you have marked your mitigation block, the next step is patience. Okay, instead of entering a trade too early, wait for price to return to the block. All right, when it does, you look for signs of rejection such as weeks, smaller time frame structure breaks. All right, you can go to a smaller time frame. You can go to a smaller time frame to look for structure breaks, okay, or order flow confirmation. This helps you avoid getting trapped and allows you to align yourself with the institutions that are driving the market. Okay, now another key point is discipline. Okay, not every block will be respected. We just have to accept that fact, right? And sometimes price won't return to a mitigation zone at all. So this is why it is crucial to combine mitigation blocks with overall market structure. The overall market structure, it is very, very important. Okay, so you combine with overall market structure, liquidity areas, and other smart money concepts. Now, the more confluences you have, the stronger your setup becomes. To sum it up, mitigation blocks in trading are powerful tools for understanding why price returns to certain levels and how you can use that knowledge to refine your entries. Now, by focusing on these zones, you will stop chasing the market and instead you wait for it to come to you. Okay? Now, using this as an example, you can see on the 5 minute chart, we're already having, price already seems to be forming a sort of structure that descending triangle pattern, which is usually bearish. So we might actually have a breakout from here, possibly price come back to test this zone. So we'll likely have price mitigate this order block here, and then probably we could have maybe a little consolidation and whatever. It might get rejected immediately, and then we have price going back up, right? Or whatever, right? So now, whenever you have identified a mitigation zone, mitigation block, just can come down to the lower time frame, watch out for confirmations, watch out for how price reacts, and do the needful. Always get confirmations before taking the trade. Always get confirmations. It's very, very important. Get your confirmation. So if you get a confirmation around here, you can hop into that trade. Then if you're sure that your confirmation is, you got your confirmations right, then you can just set your stop loss below that zone. Then your take profits can now be around the that high where price reversed down, right? That high where price reversed down, you use that for your take profit. So it's super easy. Okay, it's a it's a simple strategy. Okay, so if you found this video helpful in breaking down mitigation blocks, make sure to click the like button and subscribe to the channel for more smart money strategies and trading education. Drop a comment below and let me know what concept you'd like me to cover in future videos. Thank you for watching, and I'll see you in the next breakdown.